Welcome back to Vantage. We've got a new manager on the show. The thing I was interested in is just how tenacious he was in terms of starting up his fund. He's a value investor. He's very clear about what he's looking for. He's looking for those compounders that are going to deliver him long-term returns over a 3-5 year period. He's got a global mandate. Let's go take a look. Welcome back to Vantage. I am delighted to get a newish manager to Vantage. He's actually someone that Edison's known for a long time, but first time I think on camera. Peter Smith from Harbour Capital. Welcome to Vantage.
Thank you very much. Thank you for having me.
Let's start by just introducing yourself and the journey that brought you to Harbour Capital.
Sure. Well, I'm Peter Smith from Dallas, Texas. I've been in London here now for 15 years. And yeah, the journey's been a long one, but it's a very satisfying one. Unlike Warren Buffett, I guess I didn't start buying stocks as a child, but I did have an interest from fairly young. I took an economics class when I was in high school, introduced to compound interest into the stock market, and at that time it was the .com. Everybody was raging about it, so it was pretty early that I got interested. Did finance, international business during university. Got a job in London at a German bank, having learned German while I was at university. Mm-hmm. And I started off in sales and research, but I really didn't find my niche. I was never a natural salesperson, and what I really loved was the analysis. And I did the CFA. And I decided to use business school as a way to move into the fund management side of the business, because that's what really, that's what I woke up in the morning to do, was to look at research, look at companies, talk about companies, and I really wanted to take responsibility for my own ideas and not just talk about them. And the banks, they're very a lot of conflicts of interest, and it was really wanted to go help clients and not. And really succeed in that way. So I decided London Business School. They have a value investing course there, taught by, or at that time it was taught by Eddie Ramsden, and that course absolutely changed my life. He had taught at Columbia. After he had took the course there, he was seeded into business by Joel Greenblatt, a well-known value investor. And when I heard his journey, I was deeply inspired, saying, I don't like the big places. I don't want all the bureaucracy. I want to focus on performance and on being a great investor. And when I heard his story, that's what I want to do. And I sort of tried to copy him. I went out and I wrote letters to a lot of famous investors, and they're probably all rubbish if I read them now. Probably shouldn't do that. But at the time, I was very keen to find somebody to help me and mentor me, but also I wanted to start my own thing. And when I was at London Business School, one of my colleagues actually said, "Hey, I really see what you're doing. You're in the Bloomberg room every day. You're working, you talk, this is all you do. You live and breathe this. I happen to know a guy. His name's Francisco Garcia Perez." And I was like, "What? So you just happen to know the most famous investor in Spain who's like one of the best track records in the value investing community in Europe?" And he's like, yeah, I know him. Would you like to have a coffee with him?" And so he arranged that, and I met Paco, and I pitched him a couple of stock ideas, and then I was like, "I think you should give me a lot of money to start my own fund with." And he was a very, very nice gentleman, and said, "Okay, I don't know who you are, but nice meeting you. We'll maybe be in contact one day." And so then I had to go get a real job. I went and worked for a hedge fund for a couple of years, but I actually had his email address, and I kept sending Paco investment ideas. And after a couple of years, he invited me to Madrid. He said, "Hey, I'm starting a company. It's called Cobus Asset Management. Do you want to come and be an analyst for me?" And I said, very flattered, but no, I don't want to be an analyst. I want to start my own fund. And he said, "Well, why don't you come work with me for a little bit and get to know each other, and then maybe we'll think about it. But I like your ideas. I like what you're doing. Let's just get to know each other." And so that's what I did. I stayed in London, but I worked for him at Cobus. And I basically ran a paper portfolio for him for a couple of years. Did very well. My ideas just happened to work out.
Yeah.
And then he finally said, "Yes, you know what? Your ideas are great. I like what you're doing. Let's start a fund."
And what stands out for me is there's the three elements in that: passion, so something you know what you wanted to do. There's an entrepreneurialism around the whole thing, and I think tenacity is the fact that you kept going until Paco gave you the seed, right? Okay, but and I think you mentioned some of them, but we can go into a little bit more detail before we get into the fund. So, give us a little bit more detail in terms of the influences of the people who sort of inspired managing that money, and what was it about them that sort of drove you?
Yeah, I mean, obviously, I'm a value investor, so it's going to start with, I read The Intelligent Investor, Benjamin Graham, got Warren Buffett, read all of his annual reports, and just the stuff just clicks. It's just common sense, right? This is just, why would you run money any other way except to think of them as businesses and to think as a business owner and to look for competitive advantages? And you read people like Joel Greenblatt and Seth Klarman, and you just see that to me, makes no sense to do anything else. So there's and you learn Phil Fisher's book, you do your own deep research, you got to go out and do those things. And that's what we tried to do at Palm Harbor, is we tried to kind of follow this idea of, we want to do our own research, we want to think independently, and we want to really understand the companies that we're invested in. It's not just, we're not shading paper, we're not just trying to do some sort of market timing or anything. It's literally, we want to understand the businesses, the competitive nature, who can take market share, what's going on with the margin, what's driving sales, talk to the suppliers, customers, all the competition. We talk to experts, who's been in this industry for 30 years, 40 years, who knows everybody, who can say, okay, well, this is really what's going on. And we go to trade fairs. Don't talk to just the CEO who's often very promotional or something. Go talk to the level 2, level 3. Talk to somebody who's just product development or something, and then you can really begin to understand how these people are thinking and how they're competing. And it's people like the professor I mentioned, Eddie Ramsden. In the course, he basically said you have to go make 100 phone calls. And it's hard to just pick up the phone and call somebody you don't know and then ask them for a bunch of free information. But you have to do those kind of things. So like we use LinkedIn, and I just asked somebody, hey, let's have a chat. I can't offer you very much, but I'd love to get your view on this topic. And you'd be surprised how many people are willing to talk to you.
Okay. Now talk to me a little bit about the fund. So it's a young fund. I want to understand the aspiration, right? What are you trying to achieve with this fund? What do you want to hope for it to become?
Yeah, well, for me, as I said, I don't want to be this big, huge company running. To me, it's about performance. It's about, I want to take my clients' money and I want to have them have a better retirement. Be able to afford their first house, be able to pay for their kids' or grandchildren's education, meet their goals. And I think doing that by investing in a bunch of real companies, making real things, doing real cash flows, and trying to compound that money at a high rate. I say 15%, so I think roughly doubling the money every 5 years, I think is a good goal. And that's what I'm focused on. Every day I wake up trying to say, okay, do I have the right companies? Am I invested in the right companies that can take their cash flows, reinvest them at high rates, and am I buying them at a low enough price where if I'm wrong, which happens, or if something, the world changes, like we're all, people think of finances, it's all about the numbers, it's about the numbers, but it's about people and the behavioral side of things. And people change, things change, management incentives change. And so you always have to be looking at the downside and looking at the risks associated with everything. And so you're just trying to always make that balance of, are we finding the right companies with the right risk reward, so that you're taking the client's money and you're compounding it so that they can reach their goals.
I can hear that sort of value investor's margin of safety in that.
Yes, I try not to say that too often. But yes.
No, it's sensible. It's protection. Okay. And interestingly, you don't have a benchmark for the fund. So walk us through your thinking behind that.
For me, I don't want to be sucked into this psychology. So it's two things, I guess. One is I think the client can choose how I fit into their portfolio. But for me, it's the psychology. I don't want to be sitting there looking, am I outperforming, underperforming, I feel good today or bad today. Because investing, there's a lot of behavioral aspects, and you don't want to be full of emotion. You're trying to make an analytical decision on what's happening, not just today's greed, fear, let's sell everything. So you want to get all that out. And if you're sitting there comparing yourself to something every second, it's. I don't think it's a healthy way to do it. So I'm looking for, when I'm looking at companies, I'm not saying this is more expensive or less expensive than something else. I'm saying, is this absolutely going to make money? Is this absolute? It's not. Oh, it's going to be cheaper than that thing over there. So don't think having a benchmark, it makes a lot of sense to me. And it's random group of stocks, and usually in benchmarks, they're all, you're just paying MSCI money to tell you what you should be doing or whatever. And so I don't think it's a good idea. And then also, you look at a bunch of funds, like I was saying earlier, like, people change their benchmark because they're underperforming it or something.
Yeah.
And I don't know,
Yeah.
To me, it just doesn't make any sense. I want to hit an absolute target, not a relative target.
Yeah. Okay. So it keeps you focused. Is my takeaway from that? It's a pretty big brief you've got, which is you've got a global mandate. Which, given you're the manager and you're sourcing these ideas, I mean, there's a lot of companies out there. I mean, how do you actually filter that and efficiently source ideas?
Yeah, it's a good question. There's really no magic formula. It's a lot of hard work.
Yeah.
A lot of reading, a lot of talking to people. I mean, I mentioned I talked to experts in the field. I mean, after the end of the conversation, I'll be like, "Where do you have your money? What are you invested in?" I just was asking you for an hour about this one company, but what do you think is interesting? I'm not above stealing ideas. I look at other people's portfolios. I read people's investment letters as well.
Mm-hmm.
I'm a member of the Value Investors Club, Some Zero, these kind of things. So I'm looking at ideas all the time. But when you're looking, I mean, the secret sauce is not, anybody can read all this stuff, and you read the newspaper or anywhere you can get ideas from. But you just look for something that, what I said, smells good, right? There's just something that I don't know exactly what, but you're like, there's something happened. There's a spin-off, management did this, or you see the cash flows, you see what the market's thinking and why that might be wrong, or why you might have a different view. And so you're always just trying, and you just have this special kind of feeling, this, you just, like I said, it smells good, this situation, and then let's go dig into that.
Okay, and we'll get into that because we'll get some. I think we'll put some tangible names behind that to get a little bit of a feel for that. But let's say that you found something that smells good, right? Yeah. Now, what's the investment process? How do you validate that actually your gut feel is right? That you're, that you're getting, comfort that this is the right place to place your money.
Yeah, it really comes down to what's the question? Because almost every investment, I think, when you find something that's cheap or mispriced in your mind, why is it mispriced?
Mm-hmm.
And so there's always a question, and maybe you know what the answer is, or you think you know what the market's thinking, or what somebody, why is this in this priced? And a lot of times we look for, this seems like a very short-term reason for this to be mispriced, and we're taking a long-term view. Or maybe it's, so it's really a question of what the question is. And then we try to answer the question. And so what we're looking for is trying to find that expert, the competitor, this thing, what is the thing that we need to go and investigate? Is it the product? Is it the market? There's some question, and we have to just go find that answer. I mean, obviously we do all the, build a model, read the annual reports, quarterly reports, call transcripts, talk to everybody I mentioned before. We do all that and build the picture, but the real question is there's one, maybe two, three questions at most of what is our view that's different from everybody else's, and what is the answer to that? And some of it's just too difficult, and the answer is, well, maybe it's this or that, but it's just too difficult. You go on to the next thing, or it's like something that if you put that extra work in, you can find the answer, and actually I'm pretty comfortable that I'm okay with this.
Yeah. Okay. Now let's bring that to life. So I always ask people to illustrate by actual things that they've invested in. And I guess I wanted to pick something that's you've held for a long time, and then something that's new in the portfolio as a couple of examples. And then if you could wrap that up by just saying, I think you don't invest in banks, so it'd be interesting to understand why.
Okay.
Yeah.
So an old one, a new one, and banks. Okay. Yeah. So an oldish one would be, let's start with something that's, I'm going to do a U.S. stock because most of my portfolio, a lot of the portfolios in Europe, and also I'm going to do a technology stock because most people say, value investors, you're just owning very low quality.
Yeah.
So we invested in a company called Avid Technologies, and Avid is a software company, and their major software is for editing. A multi-editor software for making movies, TV shows, live news, where you can have multiple editors all working on at the same time. And they had a physical storage business as well, and now most of it's going to the cloud. But it's basically where all the editors have to know the software. So it's one of those competitive advantages where, well, everybody's using it, and so nobody's going to go and, if you have one guy says, oh, let's go use this program over here, the other 5 guys are like, no, we're all really good at Avid, we're just going to stick with this, thanks.
Yeah.
So it's just sort of like the Adobe or the Autodesk kind of, once you get people in your ecosystem, nobody wants to leave because they have to go learn something else, and then everybody's already using it. So you're like, okay, that sounds amazing. So why the heck would a value investor look at it? Well, obviously the company had problems, and back in a long time before we actually looked at it, in 2013 they got delisted from the NASDAQ. They had a massive accounting issues. They basically were booking all their revenue up front and when they should have been booking it, and then some of the revenue should have been deferred over time because when you're buying software, you're supposed to have, okay, they're doing maintenance, but they didn't do that. So they basically had this gigantic restatement, wrote down like 700 million of equity value, and then for the next 5 years, basically, they had to basically have non-cash revenue. And they have non-cash revenue, and then so basically the financials made no sense because you have huge amounts of non-cash revenue. What is non-cash revenue, right? And so your margins, I mean, everything. Like, so you couldn't like screen for this, right? It was literally you had to, and then you had a management team ran it terribly, hence why you probably had the huge accounting problem. You had a board change, management change. They got themselves into a lot of debt, very expensive. Had Cerberus and some other hedge fund guys, giving them horrible deals. But then you had a new manager come in. The new manager knew the business very well, and basically just started fixing everything from every aspect of the business. And unfortunately, we didn't find it right when he started, but a couple of years later, we were able to invest basically at a very good time, right before it all started switching from. And even now the accounting, it's gotten better, but now you're switching to software as a service, which is a whole other accounting thing, which companies are going through. So, but basically you couldn't screen, but you had to start looking at the cash flows. And if you just followed the cash flows, you just saw they're actually producing a lot of cash, and their underlying revenue is actually growing. And you could see that the quality of the software is improved and the ecosystem is getting stronger. And then they're switching to software as a service, which is also considered a quite good thing. And they were able to pay off a lot of this massive expensive debt very quickly. And then they started the SaaS journey and moving to the cloud as well. And then you got hit by COVID, and everyone was like, oh, well, that's going to be the end of it. But then we had the biggest boom in movies and cinema and everything. After Netflix took off, and then these guys, obviously did very, very well. So we didn't have that in our in our model. Oh, Netflix was going to explode. But we were able to ride that. So I think we bought the stock around $7, and it went up to $39. So yeah, it was one of those things that just...
Are you still holding it?
Yeah, we do a much smaller position now because we're very cognizant of value, so we sell as things go higher. Yeah. But then it pulled back from 39, and then we bought some more, and it's sort of a trading. Yeah. But we still think it's one of these kind of 15% compounders. Yeah. So we're happy to hold it despite it not being at the 15% free cash flow yield that we bought it at. It's now much more highly valued, but it's still just a really good company, and they tend to have market gets manic depressant mode, and you'll be able to buy it when the market's unhappy about whatever, and then sell a bit when they get excited again. Yeah.
Okay. So let's switch to something new.
Okay. So we recently bought an Austrian telco.
Huh?
So telcos are massively out of favor for various reasons, mostly capex and people having to spend a lot of money on rolling out fiber, and then the very low growth. But Austria Telekom is the incumbent in Austria, but they also are in a lot of Central and Eastern Europe, places like Bulgaria and Croatia, which actually have a lot better growth profiles than Austria does. It's owned 50% by Carlos Slim, who's trying to extract value, and if you looked at when he bought his stake to where it is now, the you look at the EBITDA margin improvement, and you look at what's going on inside the business, pretty much the lowest leveraged balance sheet in the telco space. It's, by the end of this year, should be 1x EV/EBITDA. And then the kicker, why we really like what's happening there, is there's going to spin off the telco business, the tower business.
Yeah.
And so if you looked at any of the history of people spinning off tower businesses, for some reason they're extremely highly rated. And you've already saw what Deutsche Telekom's done there, and Cellnex bought Drei, which is CK Hutchinson's telcos. And if you put anywhere close to that, it's worth like half the value of how Telekom Austria is trading at now. But we don't expect it to do that well because it's going to be a spin off and list on the Vienna Stock Exchange. But we see that because they're so under-levered, they can either move leverage to the tower business or leave it unleveraged, where they can then help participate in the consolidation of the market. We also think because they're so highly under-levered and they're producing so much free cash flow, that and they've already agreed on their business plan with the Austrian government of how much money they need to spend on the fiber rollout, that they should be able to pay a large special dividend, or at least double or triple the size of their dividend that they're paying now, which usually in telco world means they're going to re-rate the stock will re-rate to with a dividend. So we think we have a couple different ways to win. It's highly cash producing. It's like 12% free cash flow yield, very low leverage, spinning off the tower business. So yeah, we really like the setup. Now it's not a perfect. They do have 10% of their businesses in Belarus, so let's just not in the price, but nothing's perfect.
No, okay, understood. And I mean, there are the stories out there where people have those kind of sort of exposures, etc. And I think, actually over time, people have started to understand how to value that. So
well, they're still getting dividends out, and then the Belarusian currency is actually not massively depreciating or anything. It's actually doing quite well. So at the moment, it's fine. Now you can have moral, ethical questions of what we should do with it long term, but there's people there who have jobs too. And it's a complicated situation without a great answer, but something will eventually happen. It won't be like that forever. So, and whether it's resolved in a positive or negative way for the company, either way, it's probably going to help the share price. So.
Okay, and why don't you invest in banks?
Well, because I like to understand the companies I'm invested in and understand the drivers and what's going on. And I think just banks are, by their nature, very highly levered business models.
Yeah.
They have a lot of political interference in them. They are one of the few things where, as a value investor, I love to see the stock price fall and say, "Whoa, it's getting cheaper and cheaper and cheaper. I should buy more of it." But banks are one of the things where if it keeps falling, that is enough to destroy the bank.
Yeah, that's right. It's a confidence game.
It's a confidence game,
yeah.
and so you have an opaque balance sheet. You don't know, do you actually believe that, what's the incentive of the people writing the loans or the incentives inside the bank to do various things? It's really hard to tell, and you don't know who. You don't know the loan book. You can only they give you an aggregate view of it, but you don't really know what's going on inside that. And you don't know really what the covenants are like or any of these things. So you basically have a very opaque black box with incentives you're not really sure about, with political interference and a confidence game that could collapse at any time. So I just think there's easier places to fish.
Okay. Let's get on to the outlook. So we've had a first half which has been characterized by inflation, rising rates, cost of living sort of dominating. And I think the market has come to understand that and weighed up, at what point does that change? What are what's the prospects for growth longer term, and particularly the US? I think it's quite a lot of focus. What do you think the market's going to focus on in the second half of this year?
I have not a clue. I mean, we've been in the same boat for a while here. Where are we going into recession? Are we not going into recession?
Yeah.
Have we avoided that? Where is interest rates going to stop? When's inflation coming to that level? We had the China reopening. That's not going very well.
Yeah.
I mean, luckily my game has nothing to do with trying to predict what's happening in the next 6 months. I'm just looking for good companies where I can take a 3-5 year plus view and say there might be a down cycle, up cycle, look for normalized earnings. It will be very interesting to see, but I could not begin to imagine what we're going to start fixating on, because the market fixates on something new and gets excited.
Interesting.
Okay. It's not... I love to talk about it, but I have no idea what it's going to look like.
All right. That's a good, honest take on the world. Now, I think one of the, I said it at the beginning, one of the things that stood out for me as I got to know you is just tenacity. It's this idea that this is what I want to do, and you kept going and kept going. I think one of the reasons we do this is to educate, up and coming investors, people who want to go through this sort of professional journey. What's the one piece of advice that you would give to someone who's starting their investment journey, just in terms of the mindset that they should keep?
Well, you've said it, like you have to really enjoy doing it. Like you have to be naturally curious and want to learn about businesses and about the people and the products and the things. And if you can't spend 12 hours a day plus reading about these things and talking about these things, like there's a lot of people get in this business thinking, oh, I'm gonna get rich quicker or something, and like that's not what this business is about. This business is about long-term compounding money, but it's really about learning things and understanding things, and then being able to have the judgment to make judgment for investment decisions. So the one thing you have to understand is that it's about hard work, and but you have to really enjoy it. You have to be a curious person who wants to keep learning and discover everything that's happening in the world through business. And if you're not waking up in the morning being like, gosh, I can't wait to read 12 hours of PDF files, then it's not the industry for you. But I would always say to anybody, like, just find something that you're passionate about, because if you're going to do something, you should do it really, really well and try to be the best at it. And if you're going to try to be the best at it, you got to really enjoy doing it all day long. And if you're doing it just for some reason that has nothing to do with your personal satisfaction, I don't suggest doing that. So career advice to anything, just do what you really love, because it's so much better waking up in the morning being exciting that Monday morning and being like, yes, because I've working places, and you're in the shower Monday morning, you're like, I do not want to go, But luckily I found the place where I'm happy, so that's.
It's great to hear. It's great to hear. The passion really stands out. Peter, thank you very much for joining us, talking through the fund. We wish you luck in terms of scaling up the fund, and we'll track how you do. Thank you very much for watching Vantage. As always, if you've got any other managers you want to see in the future, please let me know. Drop us a line. We'd love to get them on, and we're always interested to hear your thoughts in terms of your ideas for what you'd like to see. Thanks again.